All right, I have a special guest today. I'm going to be interviewing Timothy Douglin, and he's going to provide lots of value when it comes to first-time home buyers or homeowners in general, when it comes to insurance and that sort of thing. And I'm really privileged to have Timothy here. Timothy, why don't you just give us a little introduction and tell us a little bit about yourself?
Fantastic. Thank you, Dwayne. As you said, my name is Timothy. I have been in the financial services business for 8 years. Right now, I'm working with Experior Financial Group, and our focus really is building financial foundations for families to empower them today and leave a legacy for tomorrow. So basically, we're really about really securing uh, families' financial position, their foundation. We do insurance, we do debt reduction. We also look at how to help them grow their finances, those types of things. And basically, I really enjoy what I do. I really enjoy educating people, equipping them, and empower them so they're much more informed and make better decisions for their financial future for themselves and their family.
That's awesome. And we met at Rotary, part of my Rotary Ancaster AM. You gave an amazing presentation, and we were happy to have you there. We learned a lot. So that's why you're here today. I'm like, I can't wait to answer these questions. So, Timothy, to start it out, I've got a few questions, about seven of them that I want to run through that I think homeowners and first-time home buyers would want to know. And where it comes into play is a lot of times when we're working with a new client, they're about to do a new home purchase. You know, they think of insurance like their home insurance and their automobile insurance, but there's a lot more insurance, like mortgage insurance and that sort of thing. So, and I find that conversation tends to be a little bit confusing. So, I think having you on today is going to be very helpful. And we'll start out with the first question that I have here, and that's, what are the benefits of securing life, disability, critical illness insurance for say, a first-time home buyer?
Fantastic. Well, great. Thank you for the question, Dwayne. The important thing is when a home buyer purchases a home, it's usually their biggest asset because you're putting down a lot of money for many years, and you're hoping, hopefully, that throughout those years, your income will keep on coming in. You're hoping, and for many years, you stayed healthy and everything goes fine. So by the time the maturity date comes, you can put that mortgage to rest. So what we do in terms of we try to look at say, okay, yes, your mortgage is an asset, but one of the biggest things is your ability to earn an income is an asset as well. So when it comes to breaking down life insurance, disability, and critical illness, let's start with life insurance. Life insurance is basically, God forbid, if you prematurely pass away and you have your spouse, your partner, or loved ones there in the house. You want to make sure that your interest, your life interest, is continued. The lifestyle can continue for the ones you love. So that lump sum payment, tax-free payment, comes in and it will replace your income when you're no longer there. So make sure that your mortgage gets paid off or that your expenses get paid down, those types of things. So hopefully none of us came in this world with a guarantee that we'll live forever. We don't have a lease in life. So life insurance is that backstop to make sure to underwrite our life. So if we run out of time, our family doesn't run out of money.
Great answer. And that happens all the time. We hear it. I have many people that I work with that have the stories. I have a personal story where a friend of mine, their husband passed away and they had insurance that covered off the mortgage and other insurance that covered other things. And it's just, it's a horrible situation, but being covered certainly will protect you for sure. Kind of leads me to the next question I have here and there. And how can different types of insurance complement each other for like comprehensive coverage, for example?
Fantastic. Good answer. Well, in terms of, we think of life insurance when someone passes away, but what if they don't pass away? So say someone has an accident or they are disabled on the job or something to that effect. That's where disability insurance will come in. So disability insurance is designed to replace a portion of your income. So if you cannot go to work based on for disability, your income may stop from your workplace, but through the insurance, it will continue for a number of years, maybe 1, 2 years, maybe more than that, depending on how it's designed. But the goal of disability insurance is to replace a portion of your income so that if your income stops through working because you can't work, the disability insurance will continue to cover that income so you can manage your expenses, so you can stay in your home. Funny enough, the thing is, a lot of people go into foreclosure not because of life, but because of disability. So
Really?
yeah. So having that extra protection really is important. And the other one that kind of complements that is critical illness insurance. It's funny because at one time, the big three, heart attack, cancer, or stroke, once that was diagnosed in the past, maybe a couple of generations ago, it was almost like a life sentence. That's why it's
Hmm.
what they call critical illness. But it's not really critical anymore. Uh, Through the advances of medications and the medical health, people are surviving that. So the beautiful thing about critical illness insurance, it was designed by a heart surgeon and Dr. Marius Bernard. And he saw a lot of people who he actually was the first one with his brother to do a heart transplant.
Hmm.
And but what he saw, and many people he worked on and helped get back on their feet, they couldn't go back to work immediately, but so their finances were very impacted. So he actually went to the insurance company and said, "We need to find something that when someone's um, income stops, they can have money to help go on." So that's
Right.
where that was designed. So critical illness insurance is designed to give you a lump sum payout, tax-free payout, in the event if you had a critical illness like a stroke, heart attack, or cancer, life-threatening cancer, so that you have the income that can cover some for medical or for anything really. Because it could supplement your disability insurance, it can supplement your income in different ways, or assets, or protect your assets. That's what they're for. So life, disability, critical illness, all kind of have different aspects of covering and protecting yourself in time of financial crisis or need.
Great answer. Great answer. So, a lot of people will get bombarded by insurance, especially when you get a mortgage, right? So as soon as you go to a bank or something like that, they're trying to get your finances, they're trying to get your mortgage and stuff like that. So when you're a first time home buyer or homeowner and you're trying to figure out where to turn to, what are the factors that clients should consider when choosing between bank offered insurance policies from the bank or from someone like yourself, an independent broker?
Basically, the bank insurance is basically not underwritten at time when you apply for it. You get a certificate. That means if you put a claim in down the road, the bank can go back and look at the question you asked. So you might say, I didn't have high blood pressure or cholesterol, and then go through your records. And if you found that the questions you answered were not um, right, they can deny you coverage. So you think you're covered, but you're not because you haven't been properly underwritten. It's called post-claim underwriting. Whereas with a broker, they actually do go through the questions, and you have to go through all the questions, answer them according to the question how they're answered, and you can be underwritten through the insurance companies. And then once you are approved, you are underwritten. So one you think you are with a bank, and the other one
Right.
you are. All right. So those are two major things. And keep in mind, one of the major differences there too is when you are assured through the bank is covering their own interest. So not information, the face value. So if you say it was $300,000 or whatever the mortgage might be, you're covered for or more, the mortgage actually for the bank, the money goes to the bank. It doesn't come to you to pay off the mortgage. Whereas if you are independently covered through an agent, when you get the money, it can be used to your family in any which way you want to pay down the mortgage or to pay some of the mortgage or to help the family in different ways. So the bank owns the life insurance where you own the personal insurance. That's one of the big differences. And the other difference is that with the bank owned one, it's not portable. So if you went down the road to get another mortgage 5 years down the road, and you went to another company, it's not portable. You can't take it over with to another company. Whereas If you're insured through a personal insurance, you own that. That's yours to cover you for the term of the insurance. So you can go to anywhere you want without losing that term. One more big thing
Sure.
is that through the bank, it's a decreasing mortgage. So maybe you may be paying off your mortgage. Say if your mortgage is $500,000, for example, and you're paying off your mortgage over time, then your insurance coverage is decreasing. You're only covered for
Yeah.
what you're paying off. Whereas if you had $500,000 to your life insurance, personal life insurance, it's $500,000. It's not decreasing unless you design it that way. So there's a lot of differences between the two. Again, it's better to have some than none. But when you go through personal insurance, you have more control. It's covering your family. You can move it from one mortgage broker to another without losing your insurance. And how you design it, you can design it in many ways to protect your family as well.
Great. That's a great answer and a great point, because with one of the products that I do recommend, and I provide quotes for my clients. It's part of our mortgage brokerage and stuff like that. You're exactly right. So the actual coverage amount is coming down because you're paying off your mortgage, but the premiums stay the same. So interesting. Yeah. So that's a very good point. I think the other thing I want to talk about is I get all different types of clients. I have everyone from professionals, doctors, dentists, business owners. You've got sales executives, things like that that are just they're good at what they do, but they're trying to figure out okay, I'm buying a house, and there's a lot that goes into buying the house and getting a mortgage. But when it comes to the insurance, how should buyers be looking at an insurance policy to ensure that it's meeting their needs? Like it's because there's so much to think about, right?
Yeah. Well, what my company, Experior, that I work with as a broker, we have what we call an expert financial analysis. And generally through our industry, we all do have to do at a compliance insurance needs analysis. So basically, it's look at where some is, look if they have previous insurance, maybe through work, personal, or through the bank, whatever it might be, and see what their needs are. And we go through a process of looking at their debts, looking at their financial position, so we can find out what their needs are, and then we can give the appropriate amount of recommendations for that person based on their budget, based on what their needs are, so they're properly covered. And it may be through temporary insurance, it may be permanent insurance, a different combination of different types of insurances with critical illness as well as disability. So we look at their what they have at work through group insurance, and that's another interesting conversation too.
Hmm.
But also we look at what they have personally, and also we look at if they have bank insurance as well. And we're based on a combination of different factors and the conversation we have with the clients, we'll come up with recommendations for them to protect them adequately, based on their health as well. Because basically, the important thing to note, again, mentioned earlier, that none of us come in this world with a warranty and saying, we're going to be always healthy forever. And so over time, we may go into a mortgage thinking we're really strong and healthy, and we are. But look, a few years ago, we had COVID.
Hmm.
That knocked a lot of people out. Nobody knows what's going to happen down the road. Um, I like to say three things. One, wealth is volatile, health is fragile, and knowledge is infantile. And what do I mean by that? Well, wealth, we want to grow money over time for sure. But we have it in market, or we might have it in real estate, or things might go up and down. So it's volatile. It can go up and
True.
down. That's
Yep.
that's important. But when it comes to our health, that's one of our greatest assets. And none of us came in this world with a guarantee that we're going to be healthy forever. So when it comes to having life insurance, disability, and critical illness insurance, other types of insurances, they're there to protect our health. And that's so important with that. And I didn't mention one of the things that I'm a certified health insurance specialist. So I specialize in those type of areas as well,
Hmm.
as well as I'm a registered retirement consultant. So when it comes to making sure planning for someone's future, those things are really important. So whether someone is basically just starting out as a first time home buyer, someone who has high net worth, I like to ask the question: when you went to school, when you got your formal education, did you get a financial education at that time?
That's a no.
Yeah, yeah. And most people will say no. 90%, 9 out of 10 people say no, I did not. And that's the problem. When it comes to things like um, insurance or investments or real estate, mortgages, none of us get that type of information. So it's important to work with professionals in the field so you can get insights and information that can help you make better buying decisions and could save you hundreds of thousands of dollars down the road just in terms of making that right decision at the right time.
That's a great answer. And I think that leads me to the next one. And like I said in the beginning, a lot of people I talk to, they're just not aware of the different policies and what they should get. And when it comes to misconceptions, I'd like to know, what are some of the common misconceptions about home-related insurance policies? And I'd love to get your thoughts on that.
Well, one of the misconceptions is, first of all, I'm young. I'm going to be okay. I don't need insurance.
Hmm.
That's one. The other one is basically my group insurance is going to cover me so that I'm okay. I'm covered. I got insurance. But people don't realize when you look at your insurance through your group insurance, it might cover you a flat rate. It might cover you for one time your salary or even two times your salary if you're lucky. So people don't really look at that.
Hmm.
When it comes to disability insurance, it might cover you for 1 year or 2 years, depends. Or it may not cover you at all. You may not have it. When it has critical illness insurance, that's usually optional. So people may think they have all three, but they don't, because what people think about when it comes to group insurance is health and dental, those types of things.
Right,
But when it
of
comes to
course.
other thought, they don't really think about that, but they assume they have it. So if you only have one or two times your um, salary, if you had a mortgage to pay and your mortgage is going to pay off in 10, 15, 20 years, and you only got 2 years of salary, it's not going to go too far. So we want to make sure we cover for many years opposed to a couple of years.
That's awesome. So we've been talking a lot of more about first-time home buyers and people getting into the market and maybe younger homeowners and that sort of thing. But are there products out there for people that maybe are in their 40s and they're starting to think about retirement now? And, I see a lot because I do a lot of different types of mortgages for people. Like, in fact, we're seeing a huge increase this year in reverse mortgages. And these are where, you've got a couple, they're in retirement, they don't have huge savings, and maybe they don't have an insurance policy, and one of them gets sick and they need help, and they want to stay in the home, but they don't want to, they don't want to leave their community that they grew up in, that they know of, where their friends are and their support is, but they don't have the funds to stay because somebody's been sick, and so they need to get some in-home care. So I'm seeing a lot of uptick in reverse mortgages to help cover the costs. But what are the insurance policies that somebody should be thinking about maybe at 40, that maybe you want to have something in place for retirement, you know
That's a really excellent question. It's really interesting you ask that question because at one time, many of the insurance carriers, the big names, had what we call long-term care insurance,
hmm
which basically meant if you fell ill, you could do they say 2 of the 6 activities of daily living. What that is, if you say, for example, let's say you had COVID
hmm
and you were laid up in bed, you couldn't get out of bed, you couldn't go to the washroom, you couldn't bathe yourself, had a hard time feeding yourself. So two little things like bathing yourself and feeding yourself could have been 2 activities daily living that you couldn't do. If you had long-term care insurance, that could have covered you at home.
hmm
Or if worse, if you had Alzheimer's or cognitive disease, that might cover you in a facility, right? So the payout may cover you in that. But now that is no longer really, only a few companies have long-term care to take care of you in a facility. But many people, as you mentioned, Wayne, okay, Dwayne, sorry, Dwayne, many people say they want to live at home. They want to live at home,
right, and
right?
they do.
Aging in place. And you said they don't want to go and live outside a nursing home. So what's left? There's a few companies that will provide up to like $125,000 of reimbursement if you stay at home to give you a chair lift, to give you meals, will give you coverage for um, a nurse coming in your home. So there's that kind of insurance out there that will help you stay in your own home. So you're not going into your own funds to deplete the fund and then and take them out at a loss because of capital gains or taxes and so forth. There are some that you can get that you can help augment your income and protect your assets so you can stay in your home. Yes.
So you mentioned something there, and that piqued my interest. You mentioned something about capital gains. And so this is not one of the questions that I have prepared, but because I talk a lot about this with clients, so a lot of my clients are successful. They're business owners. They do really well, and they're always looking for different tax advantages and stuff like that. And I never really thought of and I never really thought of insurance as being like a vehicle that could help you with your financial planning. I'm just wondering, are there any products out there or strategies when it comes to that for, say, a business owner that's trying to be more tax efficient, or pay less to the CRA, so that sort of thing?
Well, yes, a good question. Yes, the CRA, kind of revenue agency, is your friend in this instance. Like the insurance I was mentioning to you, that you can actually get insurance to stay at home if you can do 2 of the 6 activities
Hmm.
of daily living. That insurance is under a private health services plan. What means that it's recognized through a CRA if you get basically put the premiums in. The premiums, if you're a business owner, are tax deducted from your business.
Interesting.
And if you get a benefit, it's basically tax free. Now, if you're working, the premiums can be used as a medical uh, tax expense credit.
Interesting.
So those types of policies, the CIA does look at them with a favorable eye, and so as a business owner and capital gains and so forth, you can use the premiums, right, as a tax deduction.
Yeah, and
And
I've heard of this, that you've got a substantial year, you've got a lot of revenue that's sitting in the business. You need to maybe just pay this thing out in whole. So like pay for the whole thing over 1 year, 2 year, as opposed to paying it for the rest of your life or whatever. But is there the option to do anything like that?
yeah, this the one that I'm contracted to provide for my clients is you can pay annually
Hmm.
or pay monthly. It's the benefit you receive is reimbursement. So it's renewable every year. So the price may go up slightly or may not, depend on what's going on in the claims. But the way it's designed to reimburse your expenses, to keep your expenses down, actually protect your assets, so you
Hmm.
don't have to deplete or go to your investments and take them out and get hit with a capital gain or tax. It helps you to protect your assets. Um, the way I'll position it. One of the things that I love, I like acronyms. I'm an acronym man.
I
I
know
call them
that.
TIMisms, right? Or acronyms. And the thing I look at it is the way. So like when we invest money, we talk about investments and we want to grow our money. So it's gain, GAIN. We want to grow our assets, income, and net egg. That's what we want to do.
Hmm.
But if we don't protect our assets, income, and this egg, we have pain. And that's the financial pain, the financial consequences. So we want to make sure, yes, we want to gain, but we want to avoid the pain. And with that said, there's basically 3 strategies of basically when people are looking at this strategy, how to mitigate the risk,
Hmm.
there's 3 ways people do that. One, they might say, deny it. I'm going to avoid it. It's not going to happen to me. I'll avoid it. The storm's not going to hit my house. I'm good.
Hmm.
It'll pass by. Maybe. Or they might say, I'll retain the risk. I'll self-insure. So I have a lot of money. I've got oodles of money set aside. If something happens to me, I'll just use my money to self-insure. That's okay. That might come at a price. Or that's A is avoid, R is retain, and T is to transfer the risk to an third-party insurance company. So for a small premium, you might get a bigger payout.
Hmm.
So that way, you're being wise using some other people's money, pooling your money with other people, so that if something, God forbid, happens, that money can come in and help you at the right time to help you not go into your self insurance. So there's three ways: avoid it, retain it, transfer it.
Love it.
And so I just say on the end of that, the financial, it's like I call it first aid, right? Financial first aid. So the first is financially insure your risk starting today against accidents, illness, or disability. So financially insure your risk starting today against accident, illness, or disability. Because when the storm comes, right, the storm will test our risk management strategy, that AR or T. Are you going to avoid it? That's hopefully you might.
Mm-hmm.
You're going to retain it, that's out your own money, or you transfer it, or a combination of all three.
I love it. I love it. I love your acronyms because it helps to understand it and remember it too. So we're getting to the end of this, and I think you've done a phenomenal job. I think the viewers are gonna learn a lot from this. But is there anything I didn't ask that I should have that maybe you want to talk about?
Well, I would say, how do I go about meeting with a professional advisor? Well, it's reaching out. It's reaching out, calling them, and sitting down, because most of them will actually sit down with you, do an analysis. Myself doing an
Mm-hmm.
analysis, and it doesn't. It's complimentary. You go through the process. You get information. You get education. You get recommendations, and then from there you can make a better decision. Once you get the information and education, then you can make the best decisions for yourself. So I think reach out and talk to the professionals, because they are there to help you.
And so, where do you cover? I know you're based out of Hamilton, like me. Do you cover all of Ontario or just this area? What areas do you cover?
Yeah, thank you. I cover right now. I'm licensed to cover Ontario.
Cool.
I cover Ontario.
Me too.
Yeah.
Yeah, because I have clients all over the place. I have clients in Pickering, I have clients in Peterborough, in Windsor, like and a lot from Hamilton. But yeah,
Mhm.
I'm licensed to do all of Ontario too. Well, Timothy, I just want to say thank you so much for spending time with me today and answering all these questions. We'll definitely have to bring you back on and talk more about some of these questions that viewers have. I will put all of your information in the description notes on how to get a hold of you and that sort of thing. And if anyone has any questions or wants to set up time to speak with Timothy, reach out to him. Guy's a great guy.
Thank you, Dwayne. Appreciate it very much. And I watch you. I watch you. I would say just the viewers watch Dwayne's information. It's phenomenal.
Oh,
Gives
thank you
out a
so
lot of
much.
value. It talks. It gives you great educational pieces. And if you want to learn more, check them out.
Thanks, Timothy. Bye for now.
Bye bye.